Hello, so today we are going to talk about corporate finance. So I am representing Group A. I am the leader, Miss Sarah, and followed by Chandra, Krishnan, Lavanya, and Maha. So let me discuss on my parts first, and then I'll pass to my teammates. All right, so this is the current ratio. As you can know, the current ratio measures a company's ability to pay its short-term debts using its assets. So basically, in company A, there is a steady increase, which is 1.361 in year one. Until year three, there is 1.878. So there is a steady increase. So the liquidity of the company A is increasing. There is a upward trend. Whereas in company B, the current ratio is extremely high, showing that they can pay off their short-term debts. However, this is very unlikely. So they are having slow-moving inventories or poor investment or underutilization of assets. Okay, as we know, company A is having an ideal ratio of 1.5 to 2, which is still in the ideal range, but company B has underutilized of their asset. So excess liquidity is not ideal because the money that the company gets, the assets, is not reinvested for higher returns. Now, let me talk about quick ratio. So quick ratio measures a company's ability to pay short-term debts using its most liquid asset, which excludes the inventory. So as you can see in company A, so the benchmark for quick ratio is 1. So from year 1 to year 3 is moving from 0.798 up to 0.982. So there is an increase in liquidity for company A. So there is an improve in the short-term financial health. However, in company B, we can see extremely high ratios where in the term in year 1 is 11.17 and then it drops to 5.193 and then it increases to 17.203, which is the quick ratio is very high. So this is the highest in year 3, which shows that the resources are underutilized, so the assets are not managed properly. So in this case, company A is able to pay off its short-term liabilities, but company B is having so slow growth and reduced return to their shareholders. Now, let's look at gross profit ratio. So, gross profit ratio means how efficiently a company makes profit from its sale before deducting other expenses. So, in company A, it is stable and effective. So, it has a better cost efficiency. There is a downward trend from 0.171 up to 0.14. But in company B, there is a significant drop in the 3 years. As you can see, the drop is more drastic compared to company A. So this could be because cost has increased, poor pricing or inefficient management of the assets the company have created. So company A is slightly better in cost efficiency and company B has serious cost and efficiency challenges. So now we look at operating profit ratio. So basically it's how much profit a company makes from its core operation after deducting operation costs. So the healthy benchmark that we are supposed to look at or the healthy range is 0.05 to 0.10. So company A has better production in their cost control, but there is a gradual decline from year 1 up to year 3. So there is from 0.122 to 0.094. However, this still remains in a profitable range of the company. Is still ideal, is still stable, and the company still has able to control their costs. However, in company B, it deteriorated over time. So from year 1, there is 0.118 and it's showing a negative value of 0.02 in year 3. So this deterioration could be because of high cost, weak pricing or falling sales. So company A dropped in its ratio but is still stable. It's still able to do cost control. But company B has lost from operation and is having unsustainable cost structure. Now, let's look at net profit ratio. It measures how much actual profit a company makes after all expense, interest, and taxes. So the normal range in this metal manufacturing company is 0.03 to 0.07. So in company A, there's a downward trend from 0.091 to 0.066, but it's still in a healthy range, so it remains profitable. In company B, there is a net loss in year 3, where we have in year 3 negative 0.003, even if it start out similar to company A in year 1. So this shows that they are facing signs of rising costs, sales pressure, or weak financial management. So in company A, it remained profitable in 3 years, but in company B, performance deteriorated, needing urgent cost restructuring. All right, thank you. I'll pass to the next person.
Yeah, so Chandra here presenting now for debt equity ratio. So the definition shows how much debt company uses compared to its equity. So company A used heavy debt, which led to faster growth but higher risk, which reflects in active financing and growth strategy. Company A shows relatively higher debt equity ratios over the 3 years, peaking in year 1 at 1.659, indicating higher reliance on debt financing. Although it decreases in year 2, it rises again slightly in year 3. Company B used mostly its own funds, which was safer but had limited growth potential. Company B maintains a very low debt equity ratio below 0.1, implying a conservative capital structure with minimal debt. This could suggest financial stability but also a potential undersue of leverage for growth. Moving on to interest coverage ratio, this measures how easily a company can pay interest on its debts. A ratio above 3 is considered safe. Company A performs well here. The ratios remain strong over all 3 years, showing it can comfortably meet interest obligations. Company B, however, has a concerning trend. While it had extremely high ratios in year 1 and 2, that was mostly due to low interest expenses in year 3. The ratio turns negative, which signal losses and serious financial distress.
Next, we'll be looking at fixed asset turnover ratio. The definition of this simply means how efficiently each company uses its fixed assets to generate revenue. Company A has shown improvement in year 2 but has experienced a drop in year 3. This could mean new assets haven't started contributing to the revenue yet. Company B consistently has shown a higher efficiency, using its fixed assets more productively than Company A. However, it may also be underinvested in long-term assets, which could limit the future growth of the company. Moving on to the next slide, we'll be talking about inventory turnover ratio. This simply means how quickly the inventory is sold or replaced in a company. Company A has maintained strong inventory turnover across all 3 years with only minor fluctuations, indicating effectively how the inventory is being controlled. Company B, on the other hand, shows a much slower turnover rate. This could point out to the overstocking or weak demand of both, which ties up the working capital unnecessarily. Next, we'll be looking at the accounts receivable turnover ratio. This simply means it measures how fast the company collects the payments from customers. Company A collects faster year after year, improving its cash flow and reducing the credit risk. Company B, on the other hand, collects it much slower, often taking over 80 days. This may lead to cash flow constraints and potential issues with working capital management.
Good evening. I am Mahadevan Dayalan. So I will be presenting on the earnings per share. So the definition of earnings per share is it indicates a profitability per share. Now, here as we can see, company A, all right, it is remained profitable across all the 3 years, but its earning per share is declining, which might raise concerns. As we can see, in year 3 is declining from 15.15 to 15.89 to eventually in year 3, 11.8 cent. Now, company B started strong in year 1 to year 2. But then it turns out to be negative in their earnings per share as it is suffering a loss. And this can cause a serious red flag and could lead to declining investors' confidence. Moving forward, the profit to earnings ratio. So the definition here shows market valuation of company's earnings. So company A is actually the profit to earnings has been dropping, showing investors might have less confidence of the future growth, because you see the profit to earnings is from 0.356 to 0.304 to 0.198, suggests a reduced investors' confidence, whereby company B, it is negative in year 3. So due to its losses, it's remained unattractive and investors indicating for very low marketing confidence because it reflects the poor earnings and the high market uncertainty. Thank you.
Hi, I'm presenter Krishnan. Let's start with the importance of non-financial information in evaluating companies. While financial reports tell us about profit and growth, they don't give the full picture. That's where non-financial data comes in. It's helped us understand risk, ethic, and how future ready a company really is. For example, Pressmetal is investing in solar energy and actively working to reduce carbon emission. This effort shows there are planning for a sustainable future which appeal to both regulation and investors. On the other hand, Chubi Metal doesn't publish much about environmental or social impact that could raise red flag for stakeholders who care about ESG. So in short, non-financial information adds crucial insight into a company's long-term potential and reputation. Sometimes financial number alone can't show.
Next, we'll be looking at how corporate governance plays a role in sustainability. Good governance is more than just board meetings. It's about making responsible decisions and staying transparent with stakeholders. Pressmetal stands out here, where they link executive bonuses to environmental, social, and governance goals. So the top management is held accountable for both financial and sustainability results. That kind of structure actually shows a serious long-term commitment for the company. Chubi may not have a detailed ESG plan, but they do involve shareholders in key decisions. For example, their recent AGM included open voting for directors' fees and other major items. That level of transparency builds trust. So whether it's a formal ESG integration or strong stakeholder engagement, a good governance helps companies to adapt and make smart future-focused choices.
Our final point focuses on employee welfare and human capital and how this directly impact on a company's operation. Happy, well-trained employees are more productive and less likely to leave. Pressmetal shows a clear investment in their workforce with programs like skill training, gender diversity efforts, and workplace safety. That kind of support boosts morale and reduces risk like accidents or turnover. Chu takes a more informal approach. They organize staff dinners and festive events. While these may seem small, they help build a sense of community and loyalty among the employees. In industrial like manufacturing, where technical skills and teamwork matter a lot, taking care of your people translates to smoother and more efficient operations.
So, to conclude everything, the final conclusion Financial data is not enough to evaluate a company. Non-financial info, environmental, social, governance, and employee welfare gives deeper insight. Pressmetal shows stronger commitment to sustainability overall. Chubi shows accountability but lacks formal environmental, social, and government programs. Long-term success depends on more than numbers. It's about values, people, and responsibility. Thank you.